Good morning and welcome to this Wednesday, August 2nd, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we figure out what's going on today. Looking at the futures this morning, looks like we're going to start off lower again, similar to yesterday. Right now, we've got Dow futures down 170. S&P 500 futures down 28.5. NASDAQ futures down about 130. So on a percentage basis, seeing a little bit more weakness in those NASDAQ shares. Crude oil prices up 60 cents a barrel, back near the $82 a barrel level. Going back the last little ways, $83 a barrel has been a recent high. So we want to watch that right now, 83 level. We're near it, 82. Obviously there's some upside and some downside when you're looking at crude oil. I actually like crude oil going up. I just don't like it going up too much. Because anytime crude oil is going up, it's a general sign that demand across the globe is pretty strong, and that tends to correlate with a stronger economy, stronger or at least increasing economic strength, if you will. U.S. 10-year Treasury yield up 2 basis points, 4.07%. I'm watching 4.10% there. I believe if we go through 4.10, then we will likely head to test that 4.33% that we saw earlier this year. A breakout above that, and we'll have to watch the signals in the market, because I think we're used to really low interest rates. Even at this level, we get back up to 4.30. That's still historically a pretty low rate. I would be mostly concerned with a 10-year Treasury yield that starts to move through 5%. Because if you can get, essentially guaranteed 5% return, a lot of people will shy away from the stock market. So you'll start to see money moving out of it. I don't think we're there yet, but that will be something if you want to, if there's something that maybe keeps me up at night, something down the road that we want to keep an eye on. For me, it is the Treasury market. We want to make sure that that 10-year Treasury yield doesn't go too far. I think we're okay right now, but start getting up closer to 5%, and it starts making traders think about moving their money. And that, honestly, what drives the stock market higher other than money flow, right? So we want to make sure that we're not losing a lot of money to the Treasury market, rotating from stocks to bonds. So I'm keeping an eye on that. Right now, I'm fine with it. But did want to point out now it's up 3 basis points, 4.08%. ADP employment report out this morning, stronger than expected for the second straight month. We did revise the numbers down for last month, for June. I'll talk about that in just a minute. But overall, I mean, that's where we're starting. So I'm more interested in selling during the day. We went through a really lengthy period where we were seeing a lot of gap downs followed by intraday buying. And I think that's still where we are. We haven't had nearly as many gap downs. There hasn't been nearly as much intraday buying. But I think because Wall Street has already accumulated much of what they want, we're not going to see the kind of accumulation that we had seen over the last year. And I do believe that the pace of gains in the market will begin to slow down. I think the fourth quarter, we still could have a pretty good quarter, assuming interest rates stay low enough. But after that, I see the pace of gains in the U.S. Equities slowing down considerably. But that's for another day. We'll talk about that somewhere down the road. Let's go ahead and talk about what happened yesterday, though. So on Tuesday, August 1st, we did open up a new month. The Dow Jones Industrial Average finished up 0.2%. S&P 500 down about 0.25%. NASDAQ, same area, down about 0.25%. Mid caps down 0.25%, small caps down about 0.5%. We did see more rotation into small caps and mid caps later in the day. So they got off to a rougher start, and they battled their way back and actually outperformed during the day yesterday, which I think kind of remains in line with what I've been seeing, which is I think small caps could be our leader here, maybe over the next couple of months. We'll see. Transports pulled back, lost about 0.5%, but that group's been absolutely on fire. and they're certainly deserving of pullback from time to time. Industrials up, leading the market yesterday. Industrials finished higher by about 0.3%. Utilities down 1.2%. Discretionary down 1.1%. Among industry groups where we saw some of the problems yesterday, brewers, and I'm not talking about the Milwaukee Brewers, not talking about baseball, we're talking about beer here. The Brewers down almost 4% on the day, Tuesday. Recreational services, this group's been absolutely on fire. There is a negative divergence, though. I mean, if you look at this chart, you can see that PPO has come down quite a bit. We tried one more breakout, but this was after a lengthy advance. I'm not at all surprised to see recreational services giving back some here. We could see a 50-day test on recreational services, but we did lose 3.3% yesterday. Travel and tourism down a little over 3% yesterday, kind of in a similar boat where we've had a huge run up in 2023, especially the last couple of months. And that has resulted in a flattening of that PPO as we keep trying to push higher. Yesterday, gap down, watch the 20-day. If we fail to hold the 20-day, I think this is a group that could head back to the 50. Maybe, I don't know, hit a longer-term trend support line, something like that, before turning back to the upside. I think 750 to 775 certainly could be in the cards there, especially if the August-September period is as challenging as it can be certain years. Moving on, let's talk a little bit about that 10-year Treasury yield, because I got the numbers for you here. July ADP employment report, 324,000 jobs. The market was expecting 185,000. So clearly a nice beat in terms of jobs strength. And I guess, you can look at this a couple of different ways. We welcome the job strength. I mean, obviously, it's an indication that the economy is not deteriorating, still strong, despite all the rate hikes, despite some of the inflation battles that we've had. Market remains strong. Job market does. On the other hand, we're watching that 10-year Treasury yield. And of course, when you have a strengthening job market, you're normally going to have rising interest rates. So it's a little bit of a double-edged sword, but the market in 2023 has been viewing just about all news as good news. So, having a little bit of a pullback in inflationary numbers at the same time as showing strength in the jobs market, I actually think that's kind of nirvana for equities. Now, if it comes with inflationary pressures, if inflation picks back up again with these job numbers, that could be something that could derail the market in the near term. That could give us a little bit more of a sell-off, in the neighborhood of maybe 4 or 5%, possibly even a little bit more. So that's something to watch when we get the CPI, PPI reports out later this month. If we start to see inflation, or if we even get one bad report, that could be enough maybe to send stocks a little bit lower in the short term. But that's what I would worry about with job strengthening. If jobs are strengthening and there are no inflationary pressures, and we're going to see the wage inflation numbers on the jobs report on Friday. So we'll start to get some more inflation data here later this week. And then coming next week, we'll see the CPI and the PPI. I think it's next week. It might be into the following week, but I believe it's next week. And I'll certainly be talking about that a lot more. But that would be something that I think the market could, maybe capitulate, move a little bit lower for a period of time. We'll see. The June number for the employment report, the ADP employment report, was revised lower from 497,000 to 455,000. But still, last 2 months, if we take that revised number from June, 455,000, and you tack on another 324,000 in July over the summer months, that bodes well for the economy. So looking good from that perspective. As I look at the yield, here was that 4.1% dividend or yield resistance line that I was looking at. If we take that out, there really isn't much until we get back up to that. I think I said earlier this year, it was actually in October of last year, when we were up above 4.3%. If we get through 4.10, there's a chance we're going back there. And And that could spook the market in the short term, gap downs a little here or there. I think that's partly what's going on this morning. We did have a downgrade. I failed to mention, though. Fitch downgraded U.S. long-term rating from AAA to AA plus. So AA plus from AAA. Honestly, I don't know that this has I think it's a news story. It's media. I don't really believe this has a long-term impact in the market. I mean, if we were starting to downgrade and get into some junk debt, it'd be one thing, but we're not talking that at all. With a AA plus rating, that's still pretty high, very secure. So I don't read too much into that. I just let the market do its thing in terms of its gaps. I'm looking at clear signs of rotation into areas where Wall Street would maybe be hiding out, like start moving into defensive areas and so forth. That's what would bother me. And I'm going to show you some interesting charts in just a few minutes that do not suggest that is happening. But right now, let's at least watch it just keep in mind as the 10-year treasury yield goes up, it does have the potential for bringing stocks down a little bit in the near term. The S&P 500, looking at the chart, I mean, we're still a little long in the tooth on this rally. We do have the PPO slightly lower as we continue to try to put in higher highs. 20-day test can never rule out. And when I say never, I mean never. In an uptrend, a 20-day test could come at any time. Beyond that, normally it's, negative divergence that kind of supersedes it or precedes it. And right now we've got a slight negative divergence, but not really seeing a clear-cut one. So I'd be a little careful with that divergence argument, at least with the S&P. Now, if we pull up the NASDAQ, it's much clearer to me that we've got lower PPO, higher price action, very, very strong negative divergence in play here. Again, 20-day moving average, as long as we stay above it, I'm okay. If we lose it, I think we're going to probably have a chance, or a pretty good chance, to move back down to that 50-day. That normally is what you get with a negative divergence. And like I said, this NASDAQ negative divergence does look a little bit more ominous. Clouds are a little bit darker. But it's interesting. I mentioned all the way back at the beginning of May, late April, when I was talking about all the media hype about go away in May, which I think is ludicrous. One reason I gave for that, feeling like go away in May is something really that you don't really want to pay attention to, is that May through August, May, June, July, and August, those 4 months have been historically the best month for outperformance of growth stocks. Does that sound like the period that you wouldn't want to be in the market or not in growth stocks? I mean, I certainly would want to be in growth stocks. And if you look at look at the NASDAQ, what we've done since May. I mean, May, June, July. I mean, we just keep going higher and higher. Will it continue into August? I mean, we've had such a great 3 months already. Even if we pulled back a little bit in August, it's still come true once again. Growth stocks outperform value stocks historically during this 4-month period. Now, as we get into the fourth quarter, you might think, well, the fourth quarter is the strongest quarter. Let me jump into technology. You might want to hold off on that. Technology usually does really well during the summer. It's normally when you get into the fourth quarter that we see industrials and financials lead the market. And technology normally takes a back seat. So that might not, coincide with, your thoughts of, hey, if the market's bullish, it's going to be technology. Not always. Fourth quarter, if you go back and look, I think transports have gone up during the month of November, something like 14 years in a row. And transports are strong now, but I wouldn't be surprised. Let's see a little pullback over the next several weeks in transports. And I think we'll have another big quarter in the fourth quarter with transports, probably with financials as well. Financials tend to love the fourth quarter. So it's at least good to have some of that knowledge, that seasonality knowledge. I don't trade 100% off of it, but if I know that the industrials do well in the fourth quarter and they make a technical breakout, then got two reasons. Got my primary reason, my technical indicators telling me to get in, but then I've also got that seasonality backstop, seasonality giving me those tailwinds to perhaps carry that area further. So really important to kind of put all the pieces together to the puzzle, because it's truly one great big puzzle, more than 1,000 pieces. And it takes a while to put it all together and make sense of everything that's happening. But anyway, right now, we're still kind of in this phase where, it wouldn't be a horrible thing if we pulled back, but I don't like to bet against the secular bull market advance, because many times the head just goes down and it just powers forward. And you try to come up with all these reasons why it shouldn't be doing it, and it does it anyway. So what I am right now is cautiously bullish. I'm bullish, absolutely bullish, but cautiously bullish. I recognize that in the short term, maybe we have some issues that we're going to have to deal through or deal with. IWM, Russell 2000. This was the one that gapped down, came back down. I mean, really nice candle yesterday. It's going to have to try and do it again today, because the Russell 2000 last time I looked was down close to 1%, which would take it down a couple bucks, back down to around 195 and change, maybe upper 195s to around 196. And we do have the 20-day moving average all the way down at 193. So we're still fine technically, but still a little unnerving, I know, when you get up in the morning, see futures down. But again, we're in a different market than we were a year ago, or more than a year ago. What else do we have here? Let's talk about the transports real quick. Here's that move up, flattening PPO up near the 3 level. And you can see that's where we generally have gotten to, and we struggled in the past. But remember, all the way back here in August of last year, that was that final drop within a cyclical bear market. So I'm looking more at the moves that we made in November and then in February, because I do not expect we're going back down to new lows. It's just a question of how far we pull back, if we pull back, based on the fact that we have run so much. My guess is we could potentially go back to the 50-day, which would be 6-7% on the transports, but I don't think that's the most. I don't think there's high odds. Like, I wouldn't say that it's 90% chance, but I do think there's maybe a 20% chance that we could go back there. First, let's watch that 20-day moving average. All right, let's move on into the chart of the day. I want to go over first, if you like the chart of the day, go over to earningsbeats.com, come down, hit that subscribe button after you fill in your name, email address. Make sure you set up 3 times a week. We're going to send you a 2-paragraph, 1-chart newsletter. Very simple read, usually based on relative strength, earnings, gaps, candlesticks, price volume, trend lines, all maybe sentiment, intermarket ratios and relationships. Those are the types of things, just trying to give back and teach some of the things that we've learned over the years to try and help you better manage your investments as you go forward. But that's free. You can unsubscribe at any time. So please check that out. No credit card required. We'd love to have you. And we do free events from time to time. And if you're on that list, we'll reach out to you and give you room instructions. So there's a lot of reasons to be on that subscriber list. Also, I want to point out every Wednesday at 10 a.m., we are doing a live trading room. First 2, very successful. Have had tremendous positive feedback. If you're not already a member and you've been borderline thinking about it, sitting on the fence, hopefully this will bring you in. If you sign up for a no-cost trial, you'll be in for 4 weeks, roughly 30 days. That'll give you 4. Actually, if you signed up today, it would give you 5 Wednesdays, the next 5 Wednesdays. Live trading room will be free for you to check out. We don't want members who don't want us. I mean, we don't want you just to sign up just to sign up. I believe we help all of our members. And I think most of our members agree with us, especially after the last couple of years with many of our market calls. But if for whatever reason, just you don't think it's for you, fine. Nothing lost. 30 days free. But this could change the way you approach the market. And I believe it has changed. We've had plenty of testimonials from members who say they look at the market completely different now. You probably are getting a sense of that just through these shows. But trust me, you'll get more of a sense of it if you subscribe and are a regular member and get everything that we have to offer. But 10 o'clock today, we'll do a live trading room where I'll go through and I'll potentially make some trades today. I don't, Gary, I don't trade every day, especially individual stocks. But if something looks good, I did put on a couple trades last week. We'll go over those. They both have been performing pretty well. There was one I talked about last week, Tilray, that's done really well. I didn't buy it. A little bit too risky for my blood personally. Actually, I shouldn't say that because that can be pretty risky at times. But I just wasn't interested. Stock's been a long-term downtrend, but short-term, it definitely looked like it had more room to the upside, potentially a double candidate. But anyway, we'll talk about that one. I'm sure we'll go over a lot more stocks today. So please come join me. I'd love to have you. 10 a.m. later this morning. All you need to do is start your no-cost trial and make sure you have the room instructions, and you can come in and join. So what's today's chart of the day? Well, one thing that we do for our members, so if you join, you'll start to get this. One thing we do is we do a monthly seasonality report. So at the beginning of every month, I send out a report listing, among other things, the top 20 stocks for that month. Last month, for July, Etsy was our number one stock. And Etsy hit July and a light went on. I don't know if it continues. Etsy actually does pretty well in August, and it's on our top 20 list again. But you can see all of a sudden during the month of July, Etsy took off. And not sure what we ended up going. I think we were up 20% on Etsy. And I think going back since it went public, it had averaged going up 12% a month in the month of July. That's an average July performance of 12%. And in 2023, we just finished it, went up 20%. So I'm sure when we look next year for the month of July, you'll probably see Etsy right there on top again because it had another great July. But that was just seasonality. If I show you the chart here, this is what Etsy looked like on a seasonality chart last month when I picked. So in July, you can see it goes up roughly about 2 out of 3 months. So it's not huge in that regard because it does go down 1 every 3 Julys. But look at that average return. That was going into last month. So what I did, if I actually bring this all the way over and include all 9 years, you'll see that July now is 13.1 because it just went up 20% in July 2023. Now we've moved from 63% to 67% because we just had an up month. Also, if I just bring it all the way through 2023, right now we've had 1 day in August. So this is now treating August as a full month based on just 1 day's action. So if I drag this back 1 year, this you can slide back. So watch what happens to the August and July, these 67% when I pull this back one. See, August now is 75% because Etsy must have gone down yesterday. And so it's treating August 2023 as a down month. Well, we've only had 1 day. But so sometimes you have to drag this back so that you know where you are going into 2023. Because now you can see percentage of months in which Etsy closed higher than it opened from 2015 to 2022. So this is only going back through 2022. It doesn't include anything in 2023. If you drag it forward, that's the change right there. You can see now we're including 2023. Even just 1 day in August is changing the data. So Etsy, it's just another piece of the puzzle. Again, would I trade off of this simply because Etsy was, deemed to be a great trade? Probably not. Well, I would say definitely not. But when I look at the stock and I see, hey, maybe I wouldn't have gotten in at the beginning of July because we're in this downtrend. We're back below the moving averages. But what I might have been thinking is, well, as I get closer to this price support level, maybe it's worth taking a chance. Because not only are we hitting price support, which would make us think, okay, good chance for a bounce, but we're also in a very strong historical month for Etsy. And so what I end up doing in these top 20, we actually create a chart list for our members, and I'll provide a couple support levels that I look at, just whatever I see quickly. Like I'm sure last month, as it was down here, I probably would have drawn a line right here. And we got down within probably $1, maybe $1.50 of hitting that. So buying into that weakness heading down towards support would not have been a bad strategy. And you can see we've had that big rally back. So I'm going to give you the top stock for August. And this is going to be a real challenge because Paycom software, look at August. Prior to this month, August, 100% of the time over its 9 years since going public, every single month, Paycom's been higher in August. And if I drag this out, it was higher again yesterday. But notice the average return went to 16% from 17.7. And that's because we only had 1 day's gain. So it's going to bring that average gain way down. But there's something that's going to be very challenging for Paycom this month. And if you've seen earnings that were out last night and this morning, you know what I'm talking about. Actually, I think this was last night. Paycom reported. And if we look at Paycom and check out pre-market action, you're going to see that the stock is down 10% this morning. So it's got a lot to kind of turn things around. Now, when I look at the chart, I see higher prices. I see a lower PPO, negative divergence, and I think 50-day test. That's first thing comes to my mind when I see a negative divergence is that there's an increased risk of pulling back to the 50. Normally, when we're going up and we're setting new highs on the PPO, I'm thinking that rising 20-day moving average is key support. But when we get a negative divergence, I start thinking maybe the 50-day. Well, today, right now, you just saw on that thing I just showed you, 331 is the pre-market. The 50-day is at 322. So this morning, it's going to gap down within $9 of its 50-day and maybe continues to sell off. I don't know. But this could be a trade I make today. I want to go in and take a look to see if Paycom beat its top and bottom line estimates. But if it did, and it pulls back and it hits that 50-day moving average, I might take a shot. But anyway, that'll be something we talk about at 10 a.m. And if you want to check that out live and see whether or not I place that trade and what I'm looking at, please join me. All right. I mentioned earlier that money is not rotating bearishly. And I want to just show you just a quick walkthrough. Just the last 5 days, we've been seeing some choppy action, market down, gapping down, rallying back, gapping up, selling off. It's just been really choppy. We opened August that way. And so I'm just looking at the last 5 days on each of the sectors. And I just want you to get a feel. So here's the XLK, and you can see we actually went to a 5-day high at 3 o'clock yesterday before selling off a little bit into the close. But look at how the XLK looks versus the other sectors as we keep going. XLY, this is another aggressive group. XLY, right here at the end of the day on Monday, we set a new high. Yesterday, we saw some selling, mostly sideways action, though. I think that's what this kind of looks like to me. How about the XLC? Well, we went up double topped right in here at about the 69 level, mostly sideways action, but near the top. How about XLI? This is aggressive, but it's a little bit more value oriented. Over the last 5 days, you see the XLI breaking to an easy new high and still apparently trending up. How about XLF? XLF kind of going down, but then bounced and now mostly sideways. Now I'm going to show you the defensive groups and notice the difference in what's going on in defense right now. Not the defense industry. I'm talking about defensive stocks, defensive sectors. So let's pull up first XLV. Here's your healthcare trending lower. XLP down near the 5-day low. We got the XLY, XLK, XLC up near the 5-day high. And we've got XLP down here setting new 5-day lows. How about XLU? 5-day lows. How about XLRE, real estate, down near the bottom? Do you see just in the last 5 days how the defensive sectors have badly lagged the aggressive sectors? Does that sound like, does it look like money is rotating out of offense into defense. I mean, if all we're getting to the downside are gap downs and we're not seeing any rotation, I have a hard time getting overly bearish. And so, hey, if you see something different than me, or if you want to interpret it differently than me, fine. I'm just pointing out, I'm not seeing any kind of mass exodus out of growth stocks into value stocks, out of aggressive into defensive. It's just not happening. So it's hard for me to be bearish. I don't care what Fitch is saying. I don't care what the news is coming out with. What is the market telling me? What is going on right in front of me on my charts? And right now, I'm just not seeing that bearishness that I think a lot of folks want to see. They're willing it down. They're hoping it down. They're wishing it down, but I'm not seeing it. I'm not seeing the reasons that would suggest we're going down. And maybe this will be different than a lot of the others. I don't know. Maybe we'll go down anyway. Maybe it'll be just a pullback. I don't know. Like I said, short term, I can't tell you what the market's going to do, but it's not giving me any intermediate long-term signals to sell. And so that's why I remain bullish. Don't forget, and I show this every once in a while, but this is my freight train sentiment indicator or Freightliner. This is my Freightliner sentiment indicator, my long-term indicator. When everybody gets overly bearish and just put after put after put after put after put has been bought relative to calls. And when that happens, put call ratio goes up, more puts than calls. So that ratio, that fraction goes higher. After a long period of time of rising, that's telling us everybody's throwing in the kitchen sink. When this starts to roll over, and I'm just showing you the chart based on history. When this chart starts to roll over, the market historically goes a lot higher. We rolled over in 2009, market took off. We rolled over in 2012, market took off. We rolled over in 2016. Remember all that sideways consolidation we had in 2015? And then early 2016, we actually pierced those lows. Looked like the market was in big time trouble. Everybody was getting more fearful. When that rolled over, market took off. Choppiness right before and during the pandemic, which I think is maybe to be expected. But look at what we're doing right now. What are we doing? We went through tremendous fear. Everybody buying puts. We went from the most bullish period in history based on the put call ratio to one of the most bearish. And it's rolling over. What's been happening since it's been rolling over? The market is exploding to the upside. So again, these signals tell me we want to remain on the long side. We don't want to bet against this market. Hey, at least see a breakdown, even if you're bearish. And I've been saying this for months. Even if you're bearish, don't ignore the uptrend that's in play. Wait for it to turn. If you had done that on the bearish side, you would have stuck with this market. Sometimes you just need blinders, ignore the news, follow the charts, and that's where we are. Until something breaks down, if I'm not seeing it in the big picture, if my other signals aren't telling me, I need to see a breakdown. And we're not getting any of that. We're trending higher, and all the signals look to point even higher. So it's hard to be bearish. Anyway, that's it. So let's go ahead and take a look how we're opening. NASDAQ down over 1%. Small caps also down over 1%. So we're seeing a little bit of weakness here. Maybe this will give us a chance to trade this morning. I would much rather trade pullbacks than strength. Also today, it's August 2nd. Typically, and August is a little weaker than many of the other months, but we're in a period where money flows are coming in. So normally the market has a tendency to go higher up until about the 5th, 6th of the month, which would be through the end of this week. August is a little bit different. We do tend to see a little weakness start creeping in around the 4th of the month. Today's the 2nd. So we'll see whether or not we can maybe bounce back again today like we did yesterday from this early selling. If not, watch the rising 20-day EMA. But I hope you'll join me later today. And if not, just do me a favor. Just click the like button below and subscribe to our YouTube channel. We'd love to have you. If you subscribe, make sure you turn your notifications on, because we do events from time to time, and we may live stream some of our free events going forward. And if you have notifications turned on, you'll be notified of that. Anyhow, thanks so much for watching. Best of luck today. Let's see what happens, and happy trading.